In this demonstration, we will go through a sample retirement projection by entering data and seeing how the program works. For the purpose of this demonstration, we will imagine two clients, a married couple, John and Mary. John was born on May 14, 1944, and is 68 years old. Mary was born on July 4, 1946, and is 66 years old. Both are retired. Let's enter their desired monthly income. John needs $4,000 a month, and Mary spends $2,000 a month. You'll notice the desired monthly income is present value and is the amount each is currently spending. It does not include taxes or any deductions they are taking. So at this point, we are looking at their net income. Moving to the next line, let's list their current assets. Let's assume that John has $500,000 and Mary $300,000. Note, these are investable assets. What we should leave out here is any cash accounts or any money that cannot be committed for a long period of time. Next, we input the money being saved by the couple. Because they are retired, we will enter 0 for all these categories. So what we are saying is this money is put aside for long term, and they are not saving any additional money because they are in retirement. The next section is the estimated earnings inflation tax rates. What we will enter here is the average expected return over the course of their lifetime. And we can see from lines G7 and I7 that their life expectancy is 95. This is the typical life expectancy we use for all our clients. So the columns headed by 5, 6, and 7% are the three scenarios that we will look at for the purpose of determining how John and Mary's assets will grow and be used up to and including age 95. The next section contains yellow boxes in which taxes are considered. The MJ stands for married filing jointly, and there are 2 deductions. We use 3.5% as our allowance for inflation. On the next page, we'll see that although they need $6,000 per month combined, that amount increases annually by 3.5%. In the line to input Social Security, we will assume that the couple receives Social Security, with John currently receiving $2,000 per month and the amount increasing annually by 1%. Team typically uses a percentage of increase between 0 and 1.5% depending on the client's age. The older the person is, the more likely that Social Security will increase. For the very young, we do not plan on continuous increase because of the future uncertainty surrounding Social Security. Back to our example of John and Mary, we assume that John is getting $2,000 per month from Social Security, and let's assume that Mary, at age 66, currently receives $1,500 per month with a 1% increase as well. Let's assume also that John currently receives a pension of $900 per month with no increase, which is typical for those clients with pensions. The next box is lump sum amounts, where we consider any lump sum deposit or withdrawal. An example of a lump sum deposit would be an inheritance you are expecting. An example of a lump sum withdrawal, marked with parentheses, would be a large purchase you expect to make. Also, this amount will not be inflated, so we want to use the future value marked with an FV designation. Let's assume that John wants to buy a new car for $20,000 next year. So we'll type car in the description box, 69 for John's age, and 20,000 in parentheses to denote a negative number, an expense. So the program now knows to take $20,000 out of John's assets next year. Moving to standard of living and the number of years box. This is a calculation the program makes to step down the client's income needs, which typically decrease as the client ages at 85 years old and again at 90 years old. We at Team don't believe it's realistic to plan for a client to spend more and more each year in the final years of life. Typically, a client spends a majority of their money early in retirement. So for our fictional Mary, we will calculate that the difference between her current age, 66, and age 85 is 19 years. During that time, we plan she will need the full $3,000. From age 85 to age 90, we will plan that Mary's income needs will be 10% less, or 90% of $3,000. And from age 90 to the end of her life, her needs will be 20% less, or 80% of $3,000. Now, we need to make sure we match up the June 12 and the June 47. We need to make them the same number. To do that, we move to the box at age 50, and we input a value that will change the 12 and the 47 to match. We'll start with a 10, and you can see the number change to 46. So let's try 11, and that brings it up to 47. That matches, so we're in good shape. For this demonstration, we will skip over the section on long-term care projections. If this is something that you're concerned about, whether you can afford it or what might happen if you don't have it, you should talk in person with a team advisor. The next section is earned income. As with lump sum, we can input age, number of years, then a negative or positive value and a percentage of increase. So if you retire but are thinking about working part-time, you can enter that as a positive value. Or if you want to help a grandchild with college expenses for 4 years, you can input that with a negative value that represents what you think it will cost on a monthly basis. For now, we will leave this blank and move on to the next page. At the bottom, you will see a Detail Combined tab. We'll click on that. So in this scenario for John and Mary, we see their age increasing. They're not saving any money. Their monthly income is $6,000, increasing by 3.5%. In addition, they need $609 the first year to pay for taxes. What we see is that Social Security and income do not equal the amount of money they need to support their lifestyle. This $2,209 figure represents how much their assets will be depleted. Their assets are in this category, and our 3 scenarios have those assets increasing by 5, 6, or 7%. What we see here in the 5% scenario is some trouble at the point where John is 95 and Mary is 92. This is a relatively positive scenario because if you look at teams' average returns, they are more than 7%. So of the 3 scenarios, a 5% return is the more conservative approach, 6% is a little more aggressive in terms of risk, and 7% even more aggressive. Now if we change some of the assumptions, for instance, let's assume John and Mary have a grandchild soon to enter college, and they want to help that grandchild starting in 2 years when John is 70. So let's assume that they will be helping their grandchild for 4 years, starting when John is 70, and it's going to cost $3,000 a month with no increase. With that new assumption, when we return to the Detail Combined, we can see the negative effect on the scenarios. Now at 5% return, John and Mary run out of money when John is 89 and Mary 87. At the 6% scenario, we see trouble where we didn't before. So this might be something they need to discuss. Can they really afford to help a grandchild through college? And what sort of long-term impact will it have on their finances? So let's play with the assumptions a bit more. Let's assume that John is 50 years old, which means he was born on May 14, 1962. Let's say that Mary is also 50, born on July 4, 1962. John wants to retire at age 68, Mary at 60, and we assume that they will spend the same amount of money. Let's also reduce their assets. So John, instead of having $500,000, now has $300,000. And Mary has $200,000. John is making $4,000 per month. Mary, $3,000 per month. They're both getting a 2% increase in their salary each year. They're not saving anything additional, so we'll keep that line blank. And their monthly savings in their 401k, taking into account the percent they are saving and the percent their employers match, is 8% for John, 10% for Mary. Social Security stays the same, pension stays the same, and we'll take out the car expense as well as the college expense. Now let's go back to the Detail Combined. Under a 5% return scenario, we start seeing red when John is in his mid-80s. In the 6% scenario, red shows up when they are both in their 90s. No red in the 7% scenario. Let's say John and Mary are uncomfortable with these results and don't want to see any red, even in the 5% scenario. So we'll have to go back and make some changes in our assumptions. Let's say that John doesn't need to live off $4,000 per month. He can live off $3,000 per month. Let's also say that instead of 8% in his 401k, he can save a little more, so we'll bump that up to 12%. Now, when we look at the results under Detail Combined, there is no red at 6%, and though there is red at 5%, it only comes in when John and Mary are in their 90s, so overall it's not alarming. But for the purpose of this exercise, let's say John and Mary don't want to see any red in either the 5 or 6% scenarios. So we go back to our assumptions. One option is for Mary to work a little longer. So let's say she'll stay in the workforce until age 68. So her Social Security will be a little bit more. Let's bump that to $1,600. And we'll move her Social Security age to 68. That added 2 years to the money supply. There's still a little red in the scenario, so we'll go back and change Mary's monthly income to $1,500. Now they are in good shape. So, you can see how through playing with the numbers you can manipulate the scenarios until you come up with something that is right for you. If you're not happy with what you see now, you have a number of adjustments you can make to create suitable results.